All right, guys, just an interesting question here in the Q&A. The question says, I read an article from ING this morning which said that the divergence we saw between the 2-year yield and the 10-year yield last night didn't make sense. They said either 10-year yields needs to rise to reflect higher for longer, or 2-year yields needs to revert lower. So just to quickly explain what the question is referring to, it's basically these moves we can see here on the chart. The blue line with blue candles here is the 2-year yield. The white candles here is the 10-year yield. So it's referring to the moves that took place in the bond market following Fed Chair Powell's semi-annual testimony that we had last night. What happened is we saw 2-year yields pushing above that 5% level and reaching a new cycle high, but we actually saw 10-year yields pushing up initially, but then failing to benefit from any additional upside and pulling back close to pre-event levels. So what the research suggests is that this divergence doesn't make sense, and either 10s needs to push higher or 2s needs to push lower. Now, to be honest, I don't really agree with ING on this view. I think it's important to remember that different things drive different durations. So let me quickly open up this chart. Let me just open up this chart. So on this chart, I've just stolen a few slides here from our macro fundamental course. Now, what you'll notice on this chart is just a very regular US yield curve chart. Now, on the next chart, it shows us the same yield curve, but split into different parts. You have a front end with bills ranging from 1 month to 3-year bills. Then you've got the belly of the curve, which is the 5s and the 7s. And then you've got the long end of the curve, which is everything from 10 years and upwards. Now, it's important, as we've mentioned many times, that different things will drive different parts of the curve in different ways. The front end is mostly driven by short-term interest rate expectations. The belly is driven partly by short-term interest rate expectations and partly by growth and inflation dynamics. Then the back end of the curve is somewhat impacted by short-term interest rate expectations, but it usually places a much bigger focus on the medium-term inflation expectations firstly, and secondly, pays close attention to the growth dynamics as well. So to understand why different parts of the curve respond or can respond differently to an event like the semi-annual testimony last night, we need to realize that the different parts are not impacted by the same drivers in the same way, at least to the same extent. Let me show you. I've got a chart here. Let me just quickly find it. Here we go. So what we have on this chart, we have the federal funds rate in yellow. We've got 2-year yields here in blue, and we've got 10-year yields in white. Now, notice how the 2-year yields, track the federal funds rate very closely. But 10-year yields tends to track it. It tracks it closely, but not as closely, right? We can see a lot of divergence between these three. Again, this is because different things matter more to different parts of the curve. The same thing impacts all of them, like short-term interest rate expectations, growth, and inflation, but the importance will be different depending on the part of the curve you're focusing on. So with the semi-annual testimony from Powell last night, what did we see happen to money markets, right? That's a real big focus here. If we quickly open up money market rates for a second, what we saw happen as we saw the markets going from expecting a terminal rate for the Fed of 4.46%, jumping all the way up to 5.64%. We saw the implied size of the March hike jump from 31 basis points up to 41 basis points, which means that it shifted the odds of getting a 50 basis point hike in March higher to that of a 25 basis point hike. Now, why did this aggressive repricing impact the 2s and the 10s differently? Well, in my opinion, it's because the 2s are mostly driven by short-term interest rate expectations. So with the terminal rate expectations jumping to 5.6%, it naturally meant that the 2s would pop higher aggressively to follow the short-term interest rate expectations. But why did the 10-year go up only marginally and then pull back to almost unchanged. Well, that's because even though 10s are impacted by short-term interest rate expectations, they are more impacted by the medium-term growth and inflation outlook. So with the markets pricing in a terminal rate of over 5.6%, it increased the odds of a hard landing or a recession in the economy. It damaged the medium term outlook for growth and inflation. I mean, as a result, take a look at this chart. This shows you the yield curve, the twos and tens spread. We pushed below 1%, I believe, for the first time going back to the 1970s. So that's not a very pretty picture for the outlook for the economy. So once you understand that different things impact different parts of the curve differently, these types of moves actually make a lot more sense, at least in my opinion. So if you just looked at the twos tens, it would have explained why we had that move. So yes, twos jolted higher because wow, the Fed might see rates at 5.6%. At least that's what the markets are implying. And the 10-year yields looked at that and said, ooh, okay, but what does that mean for growth and inflation? Doesn't look pretty for growth and inflation if the Fed is going to go even higher than what we thought previously. So I think, in this case, I don't really agree with the way that that research posed it. I don't think there's a need for tens to push up or for twos to push lower. I think the divergence makes a lot of sense because the blue one is focused on short-term rates. The white one here is focused more on growth and inflation. So hope that helps. Of course, any other questions, don't hesitate to let me know.